All right, so you've finally done it. You've hit retirement, sold that California house, and you're on your way to a state with zero income tax. You're thinking, I've escaped those high taxes for good. But what if California isn't quite ready to say goodbye?
Okay, let's talk about the nightmare scenario, the one that honestly keeps retirees up at night. Imagine this. It's been years since you moved. You get an official-looking envelope in the mail. It's from the California Franchise Tax Board, and they're telling you that in their eyes, you never really left. Now they want back taxes plus interest plus penalties. Yeah, welcome to the California Residency Audit.
You know, this quote just perfectly nails the biggest myth out there about leaving California. So many people believe that if you're just out of the state for 6 months and a day, you're golden. But here's the thing. California's tax collectors are playing a whole different ballgame. And trust me, the rules are stacked in their favor.
So if you want to win this game, you've got to stop thinking about your calendar. It is not about counting days. It's about digging into the pretty complex legal definitions that California uses to decide if you're still on the hook for their taxes. It's not about where your body is. It's about where your life is.
All right, this is super important to get. You can have a bunch of residences, right? You could have a house in Nevada, a little condo down in Florida, but you can only have one domicile. Think of your domicile as your one true home base. It's all about your intent. And here's the kicker. Until you can prove, without a doubt, that you've set up a new domicile somewhere else, California's Franchise Tax Board is just going to assume your old California one is still active.
So you might be asking, how on earth do they prove my intent? Well, they use something called the closest connection test. This whole thing came out of a big court case, and it's not a simple checklist where you just tick off boxes. Nope, the FTB literally weighs all your connections to see where your life is really centered. And get this, one really strong tie to California can completely wipe out a bunch of weaker ties you've made in your new state.
And that brings us to the main event, what tax pros call sticky ties. These are all the little personal and financial threads that an auditor will use as proof that your heart, and more importantly, your tax bill, still belongs to California. Let's break down some of the most common ones we see with retirees.
Okay, these are the big ones, the traps that so many people fall into. Maybe you kept the old house so the kids and grandkids could visit, or you held on to that country club membership. And of course, you stayed with your doctors who you've trusted for years. Each one of these seems totally harmless on its own, right? But to an auditor, they're painting a very clear picture. And that picture says, you never really left.
Let's zoom in on this medical trap for a second, because it is incredibly powerful. And look, it's totally understandable. You've got a cardiologist or an oncologist you've known and trusted for decades. Of course you want to keep them. But you have to see it from the FTB's perspective. Their logic is cold and simple. If you were really moving for good, you'd find new doctors. So, keeping that California doctor? To them, that's Exhibit A that you always plan to come back.
And then there's the family factor. This one is huge. There's this really strong legal idea that a family shares one single home base, one domicile. So let's say one spouse moves to Nevada to set things up, while the other stays behind in California so a kid can finish their last year of high school. You can bet the FTB will argue that the move was just temporary, and that means, for tax purposes, both spouses are still considered California residents. Okay, let's circle back to counting days for a minute, because the way the FTB does the math is, well, it's not what you think. They use what's called a ledger analysis. So look at this. You spent 150 days in your new home in Nevada, and only 100 days back in California. You're thinking, I win. But wait, what about those 115 days you were traveling, maybe visiting Europe or seeing the grandkids? The FTB just throws those days out. They don't count. They only compare the days you spent in California versus the days you spent in your new home state. So in this matchup, you lose.
All right, let's tackle another massive misconception. This is the so-called safe harbor rule. A lot of people hear about a magic number of days you can be out of the state, and they think it's their golden ticket to tax freedom. The hard truth? For most retirees, it's not a safe harbor at all. It's a trap.
And here it is, the magic number, 546. That's the number of consecutive days of absence that people think will automatically free them from California taxes. But, as they say, the devil is in the details. And in this case, the details are specifically designed to exclude, well, pretty much everybody. So to even have a prayer of qualifying for this safe harbor, you have to meet all 4 of these super strict conditions. You can't come back to California for more than 45 days a year. You can't have too much investment income, over $200,000. And this is the big one. Your reason for being gone has to be a written employment contract. So here's the bottom line, the hard truth.
The 546-day rule was created for employees on like a temporary assignment overseas. It absolutely, explicitly does not apply to retirees. Think about it. How can you be retired but also have an employment-related contract? You can't. Relying on this rule is probably the fastest way to lose a residency audit.
Okay, so let's say you've done everything right. You've avoided the sticky ties, you didn't fall for the safe harbor trap. You're not out of the woods yet. There is one more major danger, especially for anyone with investment properties. It's called the clawback, and it's how California can reach into your new state and tax a real estate deal years after you thought you were free. So this whole thing usually kicks off with something called a 1031 exchange. It's a really common tool in real estate. It basically lets you sell an investment property and then roll all that money into a new, similar property, and you get to defer paying capital gains taxes. You know, a classic example is selling an apartment building in LA and buying a new one in Texas.
But, of course, there's a catch. When you do that exchange from a California property to an out-of-state one, California requires you to file this special form, FTB 3840, and you have to file it every single year that you own that new property. You gotta understand, this form is basically a tracking device. It's a little annual reminder you send to California, letting them know about that deferred tax bill they're just patiently waiting to collect on. Let me walk you through how this plays out. Let's say in year 1, you sell that California property and buy the one in Texas. For the next 9 years, you're living your best life in Texas, but you're dutifully filing that form every year. Then, in year 10, you decide to sell the Texas property and just cash out. Well, because of that decade-long paper trail you've been creating, California swoops in and claws back its share. They tax you on the gain from that original property sale from 10 years ago. Just moving doesn't make that tax bill disappear.
Okay, so after all that doom and gloom, you're probably wondering, what's the solution? Well, the answer is something tax pros call a clean break. The key here is that you can't just kind of drift out of California. You have to be decisive. You have to be methodical. You have to systematically cut every single one of those sticky ties we talked about.
So let's get into the practical, actionable steps. First, and this is the big one, you need to sell your California home. It is the stickiest tie of them all. If you absolutely have to keep it, you need to rent it out to a total stranger at fair market value on a long-term lease. Second, change your team. Get a new doctor, a new dentist, a new CPA in your new state, and do it right away. Third, move your money. Close those local California bank accounts. And last but not least, the day you arrive in your new state, you march into the DMV, get a new driver's license, and you register to vote. You are literally building a mountain of evidence that proves your life has a new center. When you boil it all down, it really comes back to this one core idea. The entire case that the Franchise Tax Board will try to build against you in a residency audit is based on proving one thing, that even though your mailing address changed, the actual center of your life, your most important connections, your true home base, never really did.
So that's the real question you have to answer for yourself, and you better have the paperwork to prove it. You've moved your furniture, your clothes, your belongings, but have you truly moved your life? Because leaving California isn't just about packing up a moving truck. It's about methodically and deliberately relocating the entire center of your universe. If you don't, you can be sure that California's tax collectors will be there to argue that you never really left in the first place.